Peak Wealth Management proudly presents the Trust the Plan podcast with Nick Hopwood and Jim Pilat, where we believe by providing education and guidance, we can help you retire with peak confidence. Now, here are your certified financial planners, Nick and Jim.
Welcome everyone to the Trust the Plan podcast. I'm Nick.
And I'm Jim.
And Jim, today we're talking about, we're going to nerd out on Monte Carlo. So if you are into that stuff, this is great. If you're not into it, you might just want to skip this episode. Just kidding. All right, so what does Monte Carlo mean? We got a great visual here.
I know, we do.
All right, so this is courtesy of Mark Shishini, I guess, from Twitter. Thanks, Mark.
Yeah, I guess I don't know what the official definition of Monte Carlo is, but it's, we get lulled into the straight line, right?
Yeah.
Where everything's the same year after year. Monte Carlo means it's not the same. We randomize things. You get, 1,000 different ways of running a scenario as opposed to one way.
Yeah, so the way that Mark puts this together here, the straight line is, hey, we're adding to the portfolio every year. The portfolio is growing by X percent every year. So we just step higher every year. And so, that looks beautiful. It's a great chart here. We always end at the highest, right? Mm-hmm. But like Jim said, it's not always the same linear path every year. That would be silly.
Yeah, when we assume, a 5% rate of return, that doesn't mean every single year you're going to get 5%. It means we average that, meaning one year you might get 10, the next year you might get 0, the next year you might get 15, the next, we see a random amount of returns come in that result in the average return.
Yeah, and with the market returns, the average is like 8 or 9% or something like that. Mm-hmm. But almost no years are 8 or 9%. Mm-hmm. It's either much higher or much lower, right? And there's that volatility. There's the risk of the market. Mm-hmm. So Monte Carlo. So we end up with all these squiggly lines. So let's see if I can move this over a little bit. All these squiggly lines. Okay, and so in his example here, you show the straight line is 9.4, but the upside could be more like 26 million if you have a great market, or in the worst case scenario, just 1.4. So it's a pretty wide range, okay? So how do we incorporate this into our planning? Well, let's go straight to a case study with Mr. and Mrs. Schoolcraft. If you're a fan of the show here, you should be familiar with the Schoolcrafts. They're our good buddies. All right, so when we start with the lifetime portfolio value, right, this is like the first linear path. It turns out the Schoolcrafts are not on track for a healthy retirement. They're gonna run out. But we can play with, well, let's pull up the Monte Carlo first here. We say, well, the linear path doesn't work, but if they had the good market returns, maybe they could make it out to age 96 or so, not too bad. Mm-hmm. But we're depending on the highest possible or the best possible outcome in the markets, which we can't control. Mm-hmm. But if we go back here and toggle, they spend a little less, they work a little longer, they save a little more, and now we have a plan we can believe in, a plan we trust. The linear path looks great. So now we can toggle over to the Monte Carlo. There's our asset spread. You can see whether we have, these are our squiggly lines. The below average, we still have money left. So that's pretty good in terms of our risk, our probability of success. And so this is age 100, I believe. So they have 87% probability of success out to age 100. Yeah. And they have a 100% probability of success out to age 87, which is pretty good, beyond life expectancy. And so it's important to stress test our retirement plan. Because I don't know about you, but if I'm thinking about retiring in the next couple of years, I want to make sure that I have that 100% probability of success for a really long time, beyond life expectancy.
For sure. Yeah, I think a big part of Monte Carlo has to do with the sequence of returns and when you get those returns. We talk about averages all day long, and we can hit those averages, but you know, if you need to make a big withdrawal in a year where the market's down, that dramatically affects how the plan looks, and that's what Monte Carlo accounts for. You know, it says what happens if we need to make one of these withdrawals in a bad market year. What happens if we make the withdrawals in good market years? What are all the different outcomes of all the different scenarios that could potentially happen?
And Jim, I think that the way that we manage money in retirement with our income conductor program raises the probability of success even more. Because if you have a couple of years of money in cash, especially right now when we're earning 5% on money markets, I think it means that you're going to be in a position where you don't have to sell stocks when they're down. And if you want to learn more about income conductor, we've done episodes on that in the past. But what if you are really looking at extremes here with market timing and the market expected returns? So what if I retired in 1990? I don't know what the average return for the decade of the 90s was, but you know, that was, you know, the internet boom, personal computer boom, you know, leading up to the tech bubble. The 90s, the returns were amazing.
Yeah, it'd be a pretty good time to retire, and then immediately watch your portfolio just continue to grow, even though you're no longer adding to it.
I really wish I would have been investing in the 90s. That would have been great. But let's compare that to what if you retired in 2000? So from 2000 to 2010, we have two big crashes.
Yeah.
But ultimately a lost decade, a big zero from stocks. And so now you're living off the portfolio and making withdrawals, but ultimately earning no gain.
Yeah.
Just devastating.
Yeah, we talked about the tech bubble in episode a week or so ago, and you know, and how bad the market was and how quick it went down. But for you to retire before that time and then to see a steep decline followed by, you know, a really tumultuous 10-year period, that's a tough time to retire and watch your portfolio value decrease as you're no longer working and adding money to it.
Now let's talk about my mom. She retired in October of 07. And if you're a student of the market, you will recall that October of 07 was the high point before the financial crisis. So it started going down at that point, and it wasn't dramatic until a year later, like in September of 08, when the bottom really fell out. But you know, there were some signs like Bear Stearns. The market went down after Bear Stearns, then it came back up. Into June of 08, it was actually looking pretty up before the bottom fell out. So she retired in October 07, and she was like 59 or 57. So, let's see, 57. So she had 5 years until Social Security could even start, and that was with the reduced amount. So no work, no pension, no social.
Wow.
And now the bottom falls out.
Yeah.
Talk about anxiety. But if you're on the income conductor program, if you have a plan that you can trust, and we stress test, it can work. So she's happily retired now. Didn't have to go back to work, and you know, here we are. You know, however many, 17 years later, right? Yeah. So there's a success story. So even if you retired in the worst of times, it can still work. But tools like this can help us, you know, run it 1,000 different ways to understand what's the best case, what's the worst case, not just linear, because as we know, it's not going to be linear, period. It won't.
Yeah, I agree. And you know, you don't want to be able to retire if only we get, you know, 8% returns in the market and this and that, and then, you know, we want a high probability of success at reasonable conservative assumptions, and if we can do that, then you can truly retire with confidence.
Drop the mic, that's it right there. So if you would like to retire with confidence, or if you'd like a second opinion on what you're doing with your financial plan, please reach out to us at peakwm.com.
Peak Wealth Management thanks you for watching and listening to the Trust the Plan podcast, featuring certified financial planners Nick Hopwood and Jim Pilat. If you enjoyed our program, please subscribe and share. If you'd like to learn more about our services, please visit peakwm.com. peakwm.com today. See you next week.